Let me ask you something. Have you ever passed a prop firm challenge, felt on top of the world, and then somehow lost that funded account, and you weren't even sure what you did wrong? Well, you are definitely not alone. Today, we're going to dive into a really subtle but super destructive issue that's tripping up so many traders in these funded account programs, the prop firms. They give you the capital to trade, but sometimes there's a hidden catch, and we really need to talk about it.
And this quote right here, it gets straight to the point. It's a huge warning sign that one of the biggest dangers to your funded account might not be your trading strategy at all, but the actual rules the firm makes you play by. It's a tough question to ask, I know, but it is absolutely crucial. See, the way some of these programs are built, they can seem totally fair on the surface, but when you dig in, they might actually be creating a system where it's almost impossible to succeed long-term. So let's figure out if this might be happening to you.
So this first part is for anyone who knows they have a solid strategy, who did the work and passed the evaluation, only to then watch that funded account just disappear. It can feel like a complete mystery, and it's so frustrating. But as we're about to see, there's usually a very clear, very structural reason for it.
And this is what really stings, right? It's not just about losing the account. It's about losing this massive opportunity, and you don't even learn anything from it? You think you're following the rules, you're executing your plan, but you still fail. It really suggests that maybe, just maybe, the problem isn't with you. It's with the system itself.
Okay, so to really understand this trap, we have to look at the two pieces of the puzzle separately. Now, on their own, both of these rules can sound pretty reasonable, even like a good idea, but it's how they work together that causes all the problems.
First up, we've got the consistency rule, and on paper, it sounds good. Be consistent. Who doesn't want that? But what it actually does is act like a speed limiter on a Ferrari. The one day the market is giving you A-plus setups and your strategy is just firing on all cylinders, the rule forces you to pump the brakes. You're not allowed to build up that big profit cushion that you are absolutely going to need on the choppy days.
So just think about that. The rule is designed to enforce discipline, but what it really does is stop you from pressing your advantage when your edge is at its strongest. It literally caps your upside right when you need it the most.
All right, now for the second culprit, the trailing drawdown. The best way to think about this is like a leash that gets shorter and shorter the farther you run. As you make money and your account grows, your risk limit creeps up right behind you. This means a totally normal, healthy pullback, the kind that happens all the time, can suddenly throw you into the danger zone and get you disqualified. And this is what's so backwards about it. Just when you're finally getting some momentum, just when you're making real progress, the firm tightens the leash. Your room for error gets smaller and smaller, making the whole account way more fragile than it looks. Okay, so we've looked at them separately. Now, let's see what happens when we put them together, because this is where the trap really springs shut and where so many talented traders get caught. Just look at this. It lays the whole conflict out perfectly. On one side, the consistency rule says, nope, sorry, you can't have a massive win today. And on the other side, the trailing drawdown is screaming, hey, you better have a giant profit cushion to survive the normal dips. You're literally getting squeezed from both sides.
And yup, that's exactly it. It's a double whammy. It's not one rule or the other that's the problem. It's the combination of the two that's so lethal. You get the absolute worst of both worlds. You're held back on your best days, and you're left totally exposed on your average days. It is a perfect recipe for failure.
So what's the end result of all this? Well, first, it crams you into this tiny, narrow operating range. You can't win too big, but you also can't afford a normal loss. Second, you just can't use your edge properly. You're never able to really step on the gas when the market is begging you to. And maybe worst of all, you end up spending more time worrying about the rules than you do actually trading. It's a losing game.
Okay, enough of the doom and gloom. If that's the trap, how do we get out of it? Well, thankfully, there's a much better way, a structurally cleaner path that puts the odds back on your side.
And the solution is actually pretty simple. You need to look for firms that use an end-of-day drawdown, which is way less restrictive than a trailing one. And, this is the big one, find a firm that does not have a consistency rule. Seriously, making this one choice can completely change the game for you.
So why is this setup so much better? Well, because it's just structurally cleaner. It gets rid of all those artificial rules that are actively working against your strategy. So instead of fighting the rulebook all day long, you can actually, focus on the market. These accounts might cost a little more to get started, but trust me, the trade-off is completely worth it for the much, much higher chance of actually staying funded and getting paid.
And that brings us to the final point.
And honestly, it might be the most important one. It's about a critical shift in your mindset. It's not about getting that next payout, it's about building something that can actually last.
Man, this quote says it all. Your number one job as a funded trader is survival. That's it. Your priority isn't the next payout. It's making sure there is a next payout. Don't let these random timelines the firms cook up dictate how you trade.
Seriously, just forget about the monthly targets and the pay cycles. Those are just made-up timelines. The market could not care less about what day of the month it is. If your account simply makes it through the month, if it just survives, that is a massive win. That's the proof that your strategy is crushing it. The profits, they will come. That's the easy part, once you've mastered survival.
So I'm going to leave you with this final thought. Take a really hard look at the prop firm you're with, or the one you're thinking about joining, and ask yourself, are their rules a genuine safety net there to protect both of us, or are they a cleverly designed trap? Because the answer to that question could be the difference between a frustrating howdy and a real trading career. So please, choose wisely.